What really is this debt treatment plan for us here when we talk about domestic debt?
What the domestic debt restructuring, which has been termed as voluntary domestic debt optimization, is making this debt sustainable. We can't expect the debt sustainability to be achieved only by doing the haircut or restructuring the external debt. When the government and the central bank look at how to go about domestic debt restructuring, they have to adopt the least impactful methodology to make sure the economy starts growing. If we are to do this in a way which is minimum impact to the economy, it has to be done where we have long-term money.
What the sentiment is there when you deal with international investors, international market participants, especially with Sri Lanka reaching some consensus in terms of domestic debt restructuring?
The outlook from investors is actually very positive at the moment. Of course, there is more to be done, and there is more that we need to do in terms of our overall long-term growth trajectory. First of all, we have to get over the international debt restructuring first, and then move on into some of the longer-term measures that we need to take in order to set us on the path for a 5% growth. If these measures continue, then I think investors will come back into Sri Lanka reasonably fast.
What implications on the banking sector going forward when we've chosen the path that brings about the least number of implications upon the system?
The banking sector was the one that could have got seriously impacted if there was a domestic restructuring through the bonds, sovereign bonds of the country. Now this has been completely excluded. But the fear was if the domestic restructuring went through to the government of Sri Lanka bonds, then the banks would have had to provide additional money, because if there is a haircut or some kind of extension or coupon rate cut, that is the interest rate, then there will be some kind of day one hit, which will be so high, it will impact the bank's capital adequacy ratio. So you have to recapitalize and ask for shareholders to put additional money. This could put the banks at jeopardy. When the banks, people get kind of jittery or concerned about banks, they line up to withdraw money, and that itself could make the banks fail.
Just last week, a lot of social media campaigns asking people to withdraw their fixed deposits. Now, if we address concerns of a layman here who doesn't understand what a haircut is, who doesn't understand what this conversion means, how would you explain to them whether their fixed deposits will be harmed or not?
Very clearly, there will be no impact whatsoever to the depositors, because the banking system has been spared in the domestic debt restructuring. We have three targets to achieve. One is we have 128% of GDP as our debt, which has to be brought down by 2027 to 2022 period to 95% of our GDP. The second target is we have to achieve the gross financing needs. So that has to be brought down from 34.6% of GDP to 13% of our GDP. And the next is foreign debt financing, which has to be brought down from 9.4% of GDP to 4.5% of GDP. Now, if we are to achieve this, we have to do not only external debt financing, we have to do domestic debt restructuring.
What the sentiment is among investors overseas?
The banking system is what you really need in order to get growth back on track. So I think foreign investors would have appreciated the fact that the banks were not affected by this, because if the banks start lending, have the ability to start lending, now with interest rates having come down substantially in the last month or so, especially in the last week, the economy can get a kickstart. And for the economy to get a kickstart, you need the banks to aggressively go out and lend.
What's really happening here to the Employees Provident Fund with the debt treatment plan?
EPF has been paying about an average 9%.
9% on average to
the members.
Right.
As long as members are able to get around 9%, I'm not disputing the fact that our inflation has been, last announcement is 12%, previously it has been 22%.
So the 9% is assured, guaranteed now.
That's right. So at least 9% is what they are expecting from these bonds. We are talking of, under the restructuring, 12% return up to 2025. That is 22, 23, 24, 25. Okay. Thereafter, until maturity, 9%. So all these assumptions, one can take market interest will be 20%, one can take market interest rates will be 8%.
So are you saying there's no unfair treatment here here, if you consider the exponential interest rate increases that we've seen?
Yeah, it all depends on what the market rates will be. It will be unfair if the market rates are around 20% in the future, after 2025.
Right.
If it is under, say, 8%, then it will not be unfair at all. You are getting even a better rate. Because, see, what you have to compare is what is the market rates and liquidity. Now, that's where another issue is, if the EPF money had a haircut, where you have a liquidity issue. Now, there's not such an impact, because EPF gets money on a monthly basis from new members as well as those who contribute on a monthly basis.